Per usual, on this channel is for educational purposes only and is not intended as financial advice. It is Monday, that means it's Macro Monday. Before we get started on the charts, I have opened a Discord. It is free. The link to the Discord will be in the description of this video. We got all sorts of fun stuff, different strokes for different folks. We were talking about miners and coin and MSTR today, along with spot Bitcoin, obviously. So if you're interested, hop on in. Now, I'd be remiss to not discuss the Bitcoin edge-to-edge move on the cloud, which is now complete. And the question I inevitably receive next is, okay, what's the next trade? And this is where it gets tricky. The easy part is this setup and this move. It is most certainly not always 7-8 straight weeks of literal just straight up, okay? Typically in the pre-halving years in 2016, we'll peak above it, the weekly cloud a little bit. Halving happens, and then we sell off. This was a Bitfinex hack, Bitcoin hack at that point. In the last halving, same thing. You have a little bit of time here, right? You kind of have 2 weeks typically to get your best sell forth. But even still, you have plenty of time to make a decision. So I don't think any decisions need to be made today about spot or any of that stuff. But have some levels in mind in case we go to 48. Might be possible. Another way to look at this is just measure the fibs from high to low. I don't have it on here, but the 0.618 is where we've topped out previously during the previous pre-halving bull run periods. So if this move is no different than previous periods, we will top out somewhere between 42 and 48. The only thing that's really keeping me bullish in a pre-halving year would be the ETF announcement. So if we get the ETF announcements in January, that's still another month. We've also got tax considerations at the end of the year here for many people. Q1 seasonality is generally poor for Bitcoin. So we may have a lineup of buy the rumor, sell the news, just because of cap gains taxes, because of the excitement that we've seen so far, purely on the announcement side. The actual launch of the products, I don't know exactly the window there, if it's going to be days or weeks, whatever it is, but I think pre-Bitcoin halving, pre-launch of the actual ETFs, but post-announcement of approvals, we have this window where, look, we could go to 26, right? We could. That's in the cloud. And as some people have sort of discussed, from a trading perspective, great. If you're a long-term investor, I don't think you have anything to worry about. All this is noise anyway. But if you're looking for trades, man, that would be really something if we had a nasty pullback until halving. I think probably the most reasonable approach would be whatever the 50% retracement ends up being of this move, which looks to be probably somewhere around 30, 32, 33, whatever it is. That's also a reasonable level. Now, we'll talk about the usual, institutional crypto inflows from James at CoinShares. And this is a big reason why we've just catapulted, right? We've seen continuous flows, 10 weeks, 1.76 billion. Most of that has been Bitcoin products. Much of that has been spot products. If we look at the year-to-date flows, 1.68 of the 1.76 has been Bitcoin. Short Bitcoin also saw some inflows last week. Going to be an interesting Monday coming into those positions. I'm guessing they will be closing this week, but as I said on Twitter, look, if people keep shorting as we go up, this is how we get just nonstop rallies, because they either have to cover or they get liquidated, and that just pushes price higher. So we've seen a lot of inflows to Bitcoin, and what kind of worries me into the actual opening of the ETF is that the people that were smart enough to get connected to these products ahead of time may have bought in all of the amount that they wanted to, right? And then after these products get launched, then it's a new crop of money, new money effectively that needs to rotate and get sold on those products. Anyway, just something to think about as we get closer to the inevitable ETF launch. For the economic calendar this week, there's certainly a lot of little stuff, a few big things, jobs, tons of jobs related numbers this week. We have JOLTS, we have ADP, we've got unemployment on Friday, consumer sentiment on Friday. But the really big events is next week. There's the Fed blackout period. So we won't have any Fed speakers this week, but next week is CPI and FOMC back to back again. You'd think they'd wisen up a little bit and let the markets digest these numbers a little bit before going out there and saying what the numbers mean, but whatever. So between jobs numbers and CPI, it should be an interesting little swath of legacy data this week and next week. I'll talk about GDP real quick, just because it's kind of the oddball as far as the data is concerned. It has come down since the last estimates, more in line with the blue chip consensus. Personally, I'm not worried about it, but I know there's going to be people discussing the estimate just as they were ahead of the last print. Still positive. It's sub 2%, but it is still positive. As far as JOLTS are concerned, JOLTS are job openings. And the way they count this, it's kind of a fake number, but it's also kind of important. It's adjusted after the fact. As Goldman pointed out, there are pretty significant revisions after the fact, as there are with most of these numbers that are released, but the market doesn't really trade the revisions on any of these numbers. They trade the initial release. So the reason JOLTS is important is because Powell says it's important to him. So if JOLTS comes down, continues to come down, that may signal continuing weakening of the labor market. Depending on if you're in the recession camp or the higher for longer camp, you'll see whatever you want to see in those data points, but just something to watch for this week. We also generally have had slowing down of payrolls. So also watch for the ADP numbers and unemployment to see what those numbers are, what the revisions were. If unemployment jumps up this week, the Fed is almost certainly going to comment on that. They're going to comment on it either way, but the markets will further read that as definitely no more rate hikes this cycle. If we look at this colorful and fun chart, the white is the yield curve currently inverted. The red moving average is the monthly moving average on the yield curve, and then the yellow is unemployment. Currently, the unemployment rate's around 3.9. So if we continue to tick up, you'll notice historically that once we start to tick up, we kind of get the ball rolling, and it's impossible to really put that toothpaste back in the tube. And that's kind of the same thing with the uninversion. So it is a bit unusual that we aren't accelerating on this uninversion yet. We're still inverted on the yield curve, but we are above the monthly moving average. Takeaway here is just, look, there's room. Again, I'm not going to say the D word. I'm not going to say doomer, but the doomers can continue to doom. We can have a recession next year. That's totally fine. But the question is, what am I going to do now? What am I going to do with that information? How am I going to trade that? Do I sell everything, move to bonds? Do I buy bullets and canned food? Like, tell me what to do, because they've been constantly doomerish for 2 years. Anyway, just something to consider, think about. There's also, I just love this headline today, Dash for Trash. We are seeing an outreach towards small caps, again, with the idea that the Fed is probably done. The cycle is probably coming to an end here. Market breadth is widening out. Mag 7 cooling off. And just kind of as a sentiment gauge, tells me that we're either getting closer to the end of this cycle, or we are sort of healing this cycle, and we don't have this mega concentration on 7 companies in the entire ecosystem. As far as inflation goes, again, we're going to get a CPI print next week. Trueflation has risen from 2.1% to around 3%. Not the end of the world, but if the markets are celebrating CPI coming down, what are they going to do when CPI inevitably creeps up a little bit, which we can already start to see in the Fed's own real-time estimate of CPI for December. The weird thing here, just in the data, it is based on how it's measured, right? Core versus CPI. Core is actually coming down. PCE core also coming down versus PCE rising. So listen for any language next week on what the Fed cares about the most. I think, like super core is what they care about the most, which isn't even on here, but depending on how you want to measure this, right? Depending on how real time you want to get, we're probably going to see a rise in inflation here. UK though, doing quite well, down sub 4%. That's a heck of a lot less than they were at above 20% beginning of the year. So the tightening over there is definitely taking into effect. And if we look at just the economic releases, you have to realize the release date is a month behind. So we're getting a lagging data print of lagging data. So by the time this all like catches up with the market, we will already know that on the real-time side of things well in advance. I mean, PCE is the same, right? We just had a PCE print, and the next release isn't until the end of this month. So it is important to know where we're headed and where we're going. I just think positioning-wise, things might take some time. This is rates probabilities, again, continuing to come down very aggressively. These are usually wrong, so keep that in mind. These will fluctuate on both the CPI print, the jobs prints, the unemployment rate print after FOMC. So these are going to fluctuate all over the place. But the next meeting is the one that the probabilities are usually correct on, currently suggesting no hike, which is definitely the logical consensus here. If we look at this potato chart from from Threads, as bar chart says here, for the first time in 3 years, more central banks are cutting rather than hiking. So the Fed's hawkishness may be the last holdout relative to the rest of the world, as we can maybe afford to be hawkish for longer versus dovish and easing. But a lot of the rest of the world is already starting to cut. That's maybe important when we think about health of global economy, liquidity, and whether or not that pendulum might swing in the other direction over the next year. One thing we have seen in the US in the liquidity side is we've seen overnight reverse repo, which is ultra short-term yields, shift towards locking in also short-term yields, but longer than overnight rates. If that makes sense. So for instance, you're moving billions of dollars from overnight rates to weekly or yearly. I don't actually know how high they exchange these durations, but I believe you'd want to lock this in if you thought rates were coming down, if you thought the near-term rates have peaked, and maybe that's related to yield curve as well. But in any event, that's allowed the US government to kind of issue debt without consequence a little bit, because we've got this slush fund buffer of, which was over 2 trillion, down to 768 billion. So the question is, will the complete draining of the reverse repo align with Fed cuts? Will the Fed have to switch from QT to QE? Will the yield curve adjust at all? Things to watch for next year, but this is rapidly being drained. And something else obviously to watch is if the reverse repo is completely drained, then what, as far as yields are concerned? It gets kind of in the weeds, but I like to think of it just as this buffer of liquidity that is out, that was out of the ecosystem, is getting sucked back into the ecosystem. And you can see US liquidity year over year change here, continuing to accelerate, has throughout the entire year. And we're starting to normalize the liquidity picture a little bit relative to 2021 and 2022. And Bitcoin risk assets has certainly benefited from that. And James Lavish put together these great mega threads on anything you want to know on the macro side. So I'll put that link in the description as well if you want a better definition of reverse repo. As far as other debt rolls are concerned, there's continued talk regarding debt that needs to be rollover that was previously effectively purchased at zero interest rates, and now is going to get smacked over the head with significantly higher rates. You'll notice that emerging markets have this debt wall coming up soon. Smaller and medium-sized companies have rollover needs soon. U.S. debt profile, bonds and notes and loans, not really taking into a large effect until 25, 27, as in these bars are representing when the debt would need to be rolled over, assuming they're going to roll it over. So kind of like a wonky plumbing data point to consider, but super important if you're a small business who needs to roll your debt and you just can't, right? Because rates are too high. That effectively kills the business. So it'll be interesting, again, how does this affect the economy? How does this affect borrowing of the US government? That sort of thing going forward. Another maturity wall that a lot of people have talked about is commercial real estate, which looks even more immediate than any of those previous charts. I believe this is in billions. Yeah, billions USD. So as bar chart says here, 2.2 trillion maturing between now and 2026. Now in 2026 is a long time, but now is considerably more important with the rates where they are. You can also look to the housing market and see the screeching halt of activity there based on mortgage rates. This is kind of the same thing. There's not a lot of short-term debt issuance because rates are so high. So what happens when debt is forcibly reissued at the current rate? Likely we see problems there if rates do not come down, right? As far as health of the consumer, I don't have a estimated savings chart this week, but consumer spending seems to be slowing a little bit. Maybe people are maxing out on their credit cards. Maybe things have gotten too expensive, but it does seem to be slowing. And then if we look at year over year household spending on Black Friday versus maybe like, Cyber Monday, we're still seeing growth on a year over year basis. So there's still spending going on. We can debate whether or not it's healthy that we're loading up credit cards. I know a lot of people use credit cards just for the points and the rewards. So that's also something to consider, but we are still seeing year over year growth on Black Friday and the week after. Another quick thing about consumer health, car insurance premiums and house insurance premiums and insurance and whatever else, right? Probably not talked about enough, but Florida, man, just absolutely walloped. Nevada, New York, a lot of these states really seeing high insurance premiums. So this, of course, is going to hurt the bottom end of the consumer spectrum a little bit more than anyone else. And they're either just not going to have car insurance or they won't have a car. All right, let's transition to some price charts here for legacy. When you look at the flows, there's really no other way to slice it. Money market funds are where most of the money has gone this year. And yet equities are still basically at all-time highs. It's kind of wild. But there's a ton of money on the sidelines, as they say. A ton of dry powder. And it's likely to stay there until rates come down. This isn't like long-term yields that people are locking in. They're just seeing, as I am, right, 5% plus yield annually and getting exposed to that versus worrying about the slop and chop on the legacy side. I think most of the analyst houses on Wall Street have released their targets for next year. I'm honestly closer to the 5,000 camp than the 4,500 camp just because of the chart pattern. And I like that there's a confluence of targets here below all-time high. So it'll be interesting if next year we do hit an all-time high in the S&P. Obviously hard to predict a year-end target, but JP Morgan here continuously bearish. The S&P, to me here, still looks fine. Still looks like a cup and handle, even if you don't believe in the chart pattern. The trend on the weekly cloud still holds bullish. You had your key June bounce, cloud bounce in October. It's had a nice little run over the past 6 weeks. We can get a consolidation up here, around here. Looks ready to go eventually. It certainly doesn't look bearish by any means. And the target on this would be 56 to 61, which would be absolutely wild if that actually plays out next year. But it's something to watch, right? Q's the same target, 500 to 550 essentially. Trend definitely remains bullish. TLT kind of similar to that weekly cloud idea. It's hit its edge-to-edge target on the daily. Next step here would be to get the cloud fully bullish, to get everything back above the cloud again. So I think a bigger move in the TLT is probably done for now. And we probably see some heavy ranging going forward until the trend potentially can repair itself again. Oil on the weekly cloud looks very bearish. This is always a fear on any edge-to-edge move. You'll identify it weeks in advance, it'll hit its target, and then immediately reverse, right? If anything, this thing is headed for an Eiffel Tower all the way back down to 70. Now, based on OPEC cuts plus U.S. Department of Energy SPR refilling, this probably doesn't get too much lower, I'd imagine. But this is some ugly week-over-week price action. And if I told you there were two wars going on, one in the Middle East, and I told you to draw the oil chart, you probably would not draw it up like this. So still very much bearish on oil side, which is good for us in the inflation picture. Gold had an all-time high tick last night, has sold off considerably since then. All the gold bugs celebrating a new all-time high for the first time in 3 years. And, good for them. There's also pretty ugly inverted head and shoulders on all this. I still think it keeps going. I just don't think it's going to do anything fast. So gold to me looks okay on trend. I don't think there's any issues here. And probably you do see some sort of continuation eventually. As far as GBTC and ETHE are concerned, discounts expanded a little bit and have closed a little bit. Bitcoin around GBTC 8%, 9%. ETHE somewhere around 13, 14, 15%. GBTC has ran through the weekly cloud, which is what you want to see if you're bullish. You can see next week we will probably see a bullish Kumo twist. That's the first step towards an eventual bullish move higher, similar to 2021 when everything's above the cloud. But I personally am not expecting much further on this. Maybe we see 45, maybe we see a move on ETF approvals if GBTC is in the mix. Maybe this discount closes completely. I don't think we will see a premium on this again, but if we do, that's another great selling signal. You know, if there's a premium and it hits 45 and that's on the day of the ETF approvals, that is a great checklist for me to say, sayonara, GBTC position, was nice knowing you. ETHE very much the same, working its way through the weekly cloud there. 24, 26, certainly reasonable. Don't think we see 44 this year, but I do like a continuous move through the weekly cloud there. Coin has done really well as the GBTC discount has closed. It's kind of acted as the new proxy for crypto-related legacy activity. Previously, it had an inverted head and shoulders. It built a higher shoulder, and you're seeing bullish continuation through the weekly cloud. Same exact concept here. The edge-to-edge move brings you to 195. Fib extensions bring you from 156 to 185. There's a yearly pivot at 185. So if you're still holding this like I am, depending on how you want to play this, I like a concentration of asks anywhere between 185 and 214. So we've still got plenty of time here. And this could pull back to 108 or less. You know, I don't really care, but that's what I'm looking for going forward on coin. This is the Saylor tracker. Michael Saylor now up a cool 2 billion on his Bitcoin purchases. MSTR also continuing to move higher. Above the weekly cloud, you're getting a weekly Kumo twist. So we're definitely getting green shoots for trend. Prices returning to the midline of the pitchfork. Things look very good here. I would just caution everybody on everything that obviously, you know, we're up a considerable amount in 7 weeks here, and plan accordingly for the inevitable 20% panic drop that will ensue somewhere on something. Okay. Miners also doing extremely well, hitting their daily edge to edge, as we talked about last week at some point. They were working on a pretty ugly looking head and shoulders. It just so happens that the nullification of that pattern coincided with an edge to edge move in the cloud. And here we are. So on all this stuff, the next step is probably ugly chop, cool down, reset the momentum, reset funding, all that sort of fun stuff throughout Q1, and then get ready for fun again in Q2. BITX, also the 2x Bitcoin ETF, has a massive gap up, still has not gapped down, but did have that ascending triangle similar to spot, and looks great, right? I don't want to add to a position here, but things are certainly happening across the board. One dark horse I will present to the group is Square. 2 reasons really. One, it was a fintech that got beat down similar to PayPal, and they make a majority of their revenue, I think, still on Bitcoin sales. This is a pretty extreme range that they're in. I don't know what I even call this, but nice bounce from the lows. Maybe some sort of megaphone. Not yet in the weekly cloud, but something to watch because they have more BTC than even Riot. If we go to the Bitcoin Treasuries website, Square SQ, their block has 8,000 BTC. And again, if you're a legacy player looking for relative value trade opportunities, something crypto exposure related, you know, this is certainly on the list. Kind of embarrassing that Coinbase only has 9,000 BTC, but it is what it is. MSTR, obviously the king there at 174,000 BTC. So that's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.